So in this video today, we're going to be talking about the top 3 stocks that I'm going to be watching or buying in July of 2020. So this is a brand new series I'm very excited about on the channel here, guys, where basically every single month I'm going to cover 3 stocks that I am personally keeping an eye on that I may be considering purchasing. Now, that being said, guys, before we get into the stock picks, I just have to make a quick disclaimer here, and that is that I am not a financial advisor. This is not any kind of financial advice, and you should always do your own due diligence before investing in anything out there, and these are not buy or sell recommendations. But that being said, guys, I'm excited about this, and let's jump into my computer and cover my top 3 picks now. Alright guys, so the first stock coming in on my list is a stock that I currently own, and this is a company called Lancadia Holdings No. 2 Incorporated, and this is another one of those SPACs, or Special Purpose Acquisition Companies. We've talked a lot about these on my channel lately, and in particular we have covered one quite a bit, which is Nikola Motors. If you're not familiar, Nikola Motors is a company that is going to be a direct competitor to Tesla, and they went public through a special purpose acquisition company known as Vecto IQ. So LCA is essentially another one of these holding companies that is going to be merging with a company that has me very excited. Now, these SPACs are a little bit complicated, and it's definitely not something I would recommend to a brand new investor because they are extremely volatile. For example, on this particular SPAC that I own, I am currently down around 20%, and if you're not familiar with these types of investments, that might be something that you don't want to venture into. But essentially, companies are going public through this SPAC rather than having a standard initial public offering because it allows them to do it in a much faster manner and avoid some of the red tape and the process associated with having an initial public offering. So this right here is one of the latest SPACs that has been announced. In a second, we'll talk about what company it is merging with, but on the announcement, the stock surged to around $16 per share, and it has now retracted to somewhere around $13. As I said, these are typically pretty volatile investments and not something for a complete beginner. But I'm very excited about this company because they are merging with an online casino known as Golden Nugget. So this company called LCA is going to be merging with Golden Nugget Online Casino in the third quarter of 2020, just like was the case with Nikola Motors merging with Vecto IQ. And as the name suggests, this is an online casino that operates here in the United States. Now, why am I personally interested in investing in an online casino? Well, let's get into that right now. Currently, there is only one pure play online gambling stock that you could purchase, and that is none other than DraftKings. Now, DraftKings specializes in online sports betting, and I want to go ahead and take a look at the performance of this stock over the last couple of months related to this global pandemic. So DraftKings went public last year, and they were trading for around $10 per share for a period of time. Then, around the time the pandemic hit, this stock went soaring from around $10 per share to a high of somewhere around $40 per share. Now, the reason why this stock took off is because the online gaming industry is expected to do very well in the coming months and years, especially due to this global pandemic that shut down casinos worldwide and caused people to have to look elsewhere for gambling and other activities. And once this merger takes place between Golden Nugget and LCA, this is going to be only the second pure play online gambling stock out there that you can purchase. So based on a press release about this merger, here's what we know about Golden Nugget Online Gaming so far. First of all, they started operations recently in New Jersey in quarter 4 of 2013, and a key thing to note here is that this company became profitable in 2016. One thing we're going to talk about with DraftKings is that this company lost over $100 million in 2019, whereas with Golden Nugget Online Gaming, this company is already profitable. We know this is the first online gaming company to launch live dealer in the US. They've won industry awards as top operator 3 years in a row. They are first to launch a live casino floor in the US, and they posted net income of over $11 million in 2019. Now, what I want to focus on in particular is this sentence right here. Essentially, once the transaction is complete, it is anticipated that this new company will have a market cap or market value of approximately $745 million. Now, the anticipated revenue for Golden Nugget Online Gaming in 2021 is $122 million. So essentially, the anticipated value of this company is 6.1 times their anticipated revenue for 2021. Now, like I mentioned, there is only one other pure play online gaming stock, which is DraftKings. So I want to compare their current revenue as well as their revenue multiple compared to their current market value. So here's the financial situation with DraftKings, and this headline here says it all. DraftKings posts sizable net loss in 2019 despite major revenue growth. So revenue is growing like crazy, but they lost a lot of money. DraftKings posted a $143 million net loss for 2019, despite a 43% rise in annual revenues. According to their filing, revenue came in at $323 million, but the losses pretty much doubled year over year. So let's punch this number into our calculation here and see what kind of multiple this stock is trading at based on their current revenue. So as mentioned earlier, Golden Nugget's valuation is expected to be around $745 million post-merger based on anticipated revenues of $122 million in 2021, giving them a valuation of 6.1 times their anticipated revenue. And we know that DraftKings had $323 million in revenue for 2019. But let's consider what the current market cap or market valuation of this company actually is. So currently, DraftKings has a market capitalization of $10.94 billion. So let's punch this into our spreadsheet. So the current valuation of DraftKings stock is around $11 billion on $323 million in revenue, which means this company is currently trading at a valuation of roughly 33.9 times their current revenue. Now, Golden Nugget is going to be essentially a very similar company in the online gaming industry. However, they're claiming it's only going to be worth 6.1 times their projected revenue for 2021. Now, what I would like to consider here is a hypothetical situation. There's no guarantee this will happen, but what if Golden Nugget carries a similar valuation to DraftKings in that it is worth 33.9 times their anticipated revenue for 2021? What exactly would that look like? So if Golden Nugget does in fact earn $122 million in revenue in 2021, and if it carried the same revenue multiple as DraftKings, this company would have a valuation of around $4.1 billion. Now, there's nothing saying for sure that this will happen. This is merely a hypothetical situation. But based on these numbers, Golden Nugget could be worth up to $4 billion and is currently trading for a market valuation of just $1 billion. So my overall thesis here for this investment is that the global pandemic has accelerated this shift from in-person gambling to online gaming, and I think Golden Nugget is going to do exceptionally well here. And I also like the fact that this company is actually profitable compared to DraftKings that essentially doubled their net loss year over year despite massive growth in revenue. And if it carries a valuation anywhere near that of DraftKings, this company could be worth far more than the current market value, which is around $1 billion. But again, like I mentioned, this is merely speculation and a hypothetical situation of if this company carries a similar valuation based on future revenue, which could change. But in my opinion, I like this as an investment, so I personally decided to buy shares of LCA before the merger takes place. Now, before we get into my second pick, I just want to mention quick here, guys, that this is a commission-free trading app called Webull, available to US investors on both desktop and on a mobile app. And if you're interested in checking it out, if you open up a brokerage account with them using the link below, you're going to get 2 completely free stocks. So here's how this works. When you first open the brokerage account, you're going to get 1 free stock valued between $2.50 and up to $250. Then, when you fund the account with $100 or more on your initial deposit, you will receive a second free stock worth a minimum of $12 and a maximum of $1,400. So the minimum value of these 2 stocks is $14.50, and the maximum value is $1,650. So if you want to grab 2 free stocks, at the end of this video, guys, click that link down below, sign up for Webull, and I am affiliated with them, so I may earn a commission in the process if you do decide to use my link. All right, so coming in at number 2 on my list here is a stock called Teladoc Health. Now, bear in mind, as you can see from this chart, this stock has already had a massive run-up due to the general interest in the healthcare industry as well as the actual service this company is providing. As the name suggests, this company specializes in virtual doctor's visits and consultations, and due to this global pandemic, the use of this service has surged. As you can see here, the stock is up over 200% over the last year, and it's up over 160% in the last 6 months alone. So the stock is trading at a lofty valuation, and as you can tell from that PE ratio, this is not a profitable company. So by no means am I calling this stock cheap. It is certainly trading at a premium. But in my opinion, I think the demand for this service is going to remain high even after the pandemic is over. And if there is a chance of a second wave and people needing to utilize this service, I think it's very possible that this company could continue to do well going forward. So this right here is the service Teladoc is offering. It allows you to talk to a doctor, therapist, or medical expert anywhere you are by phone or video. Now, what I like about this company is that their service is being recommended right now by the CDC. They have advised that people seek out these virtual services if possible to avoid person-to-person contact and maintain social distancing. Not only that, numerous health insurance providers have waived the costs and copays associated with these virtual visits to encourage the use of these services. And that has led to a 50% spike in daily patient visits based on numbers that came out in March. And even before the global pandemic accelerated the growth for this company, they were a fast-growing company to begin with. Here's some numbers from the Motley Fool. The company added 14 million members in 2019, a growth rate of 61%. It ended the year with 36.7 million patients in the system, and as a result, the stock is up 330% since the IPO, even more so when we look at today's numbers compared to where this company was in March. Now, that being said, despite all this explosive growth, it's important to understand that this is not a profitable company. If we take a look at the income statement here, in 2017, they lost around $106 million. In 2018, they lost around $97 million, $98 million in 2019, and about the same over the last 12 months. So eventually, they're going to have to figure out a way to make money rather than just having this explosive growth. But I am confident that the use in this service is going to increase faster now than ever due to the global pandemic accelerating the use and essentially this being sort of a trial by fire situation. But again, I just want to restate this, based on the run-up of this stock over the last year, by no means am I calling this stock cheap. And finally, coming in at number 3 on my list here is a stock that most of us are familiar with, and that is UPS, or United Parcel Service. Now, this stock has just about recovered from the pandemic. Before the pandemic, they were trading for around $120 per share, and today they're trading for around $115. Now, this global pandemic has been a bit of a mixed bag for these transportation stocks like FedEx and UPS. On one hand, people were obviously doing more online shopping due to the mandatory closure of businesses, and we know that by looking at numbers from Amazon. On the other hand, the business-to-business side of this transportation business suffered massively due to the closure of businesses. However, numbers coming out from UPS show us that the worst is likely behind us, and hopefully the consumer segment made up for the losses in the business segment. Now, both FedEx and UPS have benefited by the Amazon effect of people doing more shopping online, but one major risk factor to consider here is the fact that Amazon is expanding their own delivery network and essentially looking to cut UPS and USPS and FedEx out of the equation entirely. But as far as which company will benefit the most in the short term from the growth in Amazon shopping, it is definitely UPS. So according to this article from investors.com, it talks about the differences between the business model of FedEx versus UPS. As mentioned right here, UPS has a focus on serving retail customers and small businesses. That is the main market that they are going after. On the other hand, FedEx derives most of their revenue from their express package delivery. In fact, it is more than half. So if you're looking to invest in a transportation company that will benefit from the growth of e-commerce, in particular Amazon, it is definitely going to be UPS over FedEx. Now, the reason why I am watching UPS in the month of July is because they have an earnings report on July 22nd. And if it's anything like the earnings report for FedEx, it should be pretty good. FedEx had an excellent earnings report, and it says right here the main reason was a surge in pandemic-fueled home deliveries, and as a result, the stock jumped over 9%. Now, there's no guarantee that this will happen with UPS. We don't know how bad the business segment was hit, but we do know that UPS is more focused on home deliveries as their business model. So, in my opinion, I think that earnings report could be pretty decent later on this month. And also, last thing I want to mention here is UPS is also a decent dividend payer with a current dividend yield of 3.52%, and I always like investing in companies that can potentially pay you in two different ways. So I think it's a solid company to keep an eye on. I'm personally not invested in UPS, and I'm also not invested in Teladoc. The only one on this list that I own is LCA. So anyways, guys, there you have it. Those are my top 3 picks for July of 2020. I would love to hear what you guys think down in the comment section below. If you have enjoyed this video and you want to see me do more like it, please go ahead and drop a like and subscribe to be notified of future uploads. And lastly, if you want to take advantage of that offer from Webull and get 2 free stocks, that is going to be the top link down in the description below. But thanks so much for watching, guys. I hope you enjoyed this video, and I will see you in the next one.